Hello and welcome. This is Property Hotline with me, Kavita Krishnan, and we are answering all your home finance queries today. With me in the studio is Ramganesh Iyer of FISDIM. Ram is going to help you with answers to all the home finance queries, like I said, related to buying, selling and investing. Ram, welcome to the show. And before we begin, of course, a quick note on the credit policy that was announced on Wednesday. Now, the RBI did keep rates unchanged, meaning that the repo rate, which is what you should be concerned with as a home borrower, stays at 6.25%. What does this mean? It means that there is no change in the interest that banks have to pay the Reserve Bank for borrowing money from the RBI. Repo rate is the rate at which banks, of course, borrow money from RBI, which means that the source of funding has not gotten cheaper for banks, which also should ideally mean that loans for you, home loans that you are borrowing, should ideally not be getting cheaper. But what we need to keep in mind here is that the RBI has cut repo rate earlier, and the benefit of that has not yet been passed on completely to borrowers like you and me. And Ram, before we go on, I would like to bring you in on that. We have seen banks announce rate cuts of late. There was a spate of rate cuts after the government nudged them, after the RBI nudged them. But even that has not really transmitted the entire benefit of the rate cuts that RBI announced. So do you see do you see more rate cuts in the offing, interest rate cuts in the offing from banks, or will this particular policy from the RBI put paid to that?
I think, banks are very much looking at the RBI for signal and directions. And the reason that they've given for not passing on past rate cuts completely is that, they have a lot of NPAs on their books. There is concerns around asset quality. So I think that status quo remains. So I think they would look to RBI for a much, stronger guidance in the coming months before they really drop their rates significantly. We could see some exceptions, but that would probably be the broad trend.
So, of course, my team will put up home loan rates over there up on the screen for you to have a look at. But we are hovering around the 8.5 to 9.5 mark right now. The lowest, of course, being 8.35%, which is being offered by a public sector bank. Do you see, so you're saying that immediately we should not really expect rates to go down further. So if you're in the market for a home loan, the time to take a loan is now? Or wait for 2 more months?
No, I think the time to take the loan is now, and also because now the loans are increasingly linked to the MPCR, the credit, cost of credit based lending. So even if rates go down in the future, you will benefit from it if you're an existing borrower. So you don't need to worry on that front.
So, right. So go ahead and take that loan. Do not expect drastic cuts in the rates in the next couple of months at least, but hopefully all the transmission that didn't happen, all the repo rate cut benefit that we didn't get, banks should pass it on sooner rather than later. On that note, let's move on to our questions for the day. Bhuvan has written in through email. Now, Bhuvan says that he made a down payment for an under construction property in Bengaluru in March 2016. In May 2016, the builder prepared this agreement for sale and asked Bhuvan to go to HDFC Bank for the loan. Else, Bhuvan says that the builder is threatening he will cancel the booking. What options does he have for this issue? Bhuvan claims that he has a valid receipts for payment. Can the builder really hold a gun to a buyer's head and say, take a loan from XYZ Bank? Is that possible?
So this is a little bit of a surprising, case out here for Bhuvan, because in general, builders are free to tie up with one or more banks where they get their properties pre-vetted and make it easy for the borrower to get a loan quickly. But having said that, a borrower is at or a buyer is at complete freedom to either take it from some other bank or even not take a loan and pay it from his or her own proceeds. So in this case, I don't think Bhuvan has any reasons for worry, and he should just go to his or his preferred bank for a loan. And as long as he's paying the installments in time and not causing an undue delay, the developer can't really take him to task. If indeed the developer tries to renege on his promise, then I think Bhuvan has a legal recourse at hand because he has receipts of his payment and the agreement that was there at that time, even if it's not registered yet. So he can go to court, for damages and take the developer to task.
Right. But before we move on, there are a lot of cases, there are a lot of projects, in fact, where developer, the bank and the buyer are essentially in a tripartite agreement. A lot of these are those projects which offer you interest subvention. So in case it is that kind of a project, then can Bhuvan go to another bank? Because obviously the other bank may not be open to giving that kind of interest subvention that that kind of facility that he's getting with HDFC Bank.
That's right. So he won't be able to get that facility with all banks. But having said that, whether or not to take that facility is completely up to the buyer. So the developer can't force him to take such a facility because it's not an unqualified positive for the borrower. There are pros and cons of taking that facility, and hence I think Bhuvan should go with his own preferences rather than be held at gunpoint by the developer.
One more question, is this also a red flag that buyers should be wary of? Because we know that in a lot of cases, entire projects have been hypothecated to banks, projects have been attached by banks because the builder in this case owes them money and has not been able to pay those dues. So in which case the idea is that whatever sale is done, the money from that sale goes directly to the bank. Could this be that kind of a scenario? Should that be considered a red flag?
This could well be that kind of a scenario. In fact, it does sound quite surprising and suspicious. If I were Bhuvan, I would be quite wary of this whole deal and this property.
Right. So Bhuvan, here's what you need to do. No builder can tell you which bank that you should borrow from. That is a decision that you should take as a home buyer, as a borrower. It is not the builder's concern where you are getting the money from, as long as you can pay that money to the builder. So he cannot force you to go to a particular bank. What you need to do is go and have a conversation with the developer and tell him that I've got a loan offer from XYZ bank and I think it's a better offer and I'm going for it. If the developer says no, then like Ram pointed out, you do have legal recourse, you do have receipts available, and you can actually drag the developer to court and also ask for interest for the payment that you've already made, not just the money that you have paid, that plus the interest. The other thing, of course, like we just discussed, is this should ideally be raising red flags in your head. It does point to some risk, some problem over there. And of course, if it is an interest subvention that you're being offered, then you need to understand that if you do not go with HDFC Bank, chances are you will not get the rate or the offer that the developer is offering you under that scheme. So these are things that you need to keep in mind. Do your due diligence and then go ahead and figure out whether or not you want to actually enter into that deal. Moving on, we have a question that's coming from Gyanesh on email, and he says that his 53-year-old son, his wife and daughter are Canadian citizens. Now they live with Gyanesh in Mumbai. Now the son wants to buy a home in Thane with a budget of 96 lakh rupees. He's already taken a 53 lakh rupees loan on a flat in Bengaluru, which has a tenure of 9 years left. Now Gyanesh's son is in the 30% tax bracket, while his daughter-in-law is in the 10% bracket. Now Gyanesh wants to know if his son can withdraw from the fixed deposit and make the balance payment. Also, can he take a loan against fixed deposits and meet the requirement? Or should he partially pay with surplus funds and a home loan? Additionally, is it better to clear the earlier loan and take a fresh loan? His son plans to rent out the Bengaluru flat. How can he save taxes on the rent amount? And also, will an HUF account be beneficial in this case? Lots of questions there. Ram, I think we should go with the home loan questions first. Yes. His son is 53 years old and falls in the 30% tax bracket. He already has a home loan running with 9 years left.
Right. So I think the first question is, should he take a loan against the fixed deposit? I would suggest not. Mainly because, bank would charge you anywhere 2 to 2.25% higher interest rate on the fixed deposit than what they give you. And there is no tax advantage on that loan either, which is available for a home loan. So you would not be advised to take a loan against your fixed deposit. You can, of course, break your fixed deposit, but I'm coming to that part now, which is, should you pay off this loan or should you take a second loan? The main point here is the interest that you pay on a home loan up to the extent of 2 lakhs a year is deductible. You can show it as a loss on house property. And now you can do that for both your self-occupied home and your non-self-occupied home. Earlier, you could do this for your rented out home without limit. Now, the budget, the finance minister has just
sadly capped it.
Has made a limit of 2 lakhs on that also. But no matter, given that your homes are of the order of 50 lakhs or thereabout is your loan, you should be able to comfortably avail both the interest tax deductions of 2 lakh each on both the home loans. You would of course need to go through the procedure. The banks will verify if you are eligible and you can repay. You have the ability to repay 2 loans at once. But subject to doing that, your son can definitely take that loan.
Also, my question here is that his son is 53 years old and he already has a home loan running which is 9 years left. What is his eligibility for a second home loan? And here I'm asking you from the age perspective, because banks are quite wary of lending to someone who's nearing retirement age, which is the case with Gyanesh's son.
Yes, of course. And I think given that, I'm assuming he's financially quite comfortable now, though he's already 53. Given that, banks, I believe, would be quite comfortable giving a loan till he turns 60, 62. Because
but the tenure would be less,
shorter.
Right?
The tenure would definitely be shorter. And of course, he would need to convince through his income statement to the bank that he has the financial ability to pay both the loans. Subject to doing that, an 8 to 10 year loan for him fresh would not be a problem, is the sense. And if you do that, then you can comfortably avail the tax benefit on both loans. And of course, you will get the rental income on one loan on one house, which you will have to show as income.
Now, you're not telling us how much money he exactly earns. They're just saying 30% tax bracket. He's looking at a loan of 96 lakh rupees, which is a huge sum for someone to take at the end of their career. Would you advise that you take a 96 lakh rupee loan?
The advantage here is, we are told that he has a fixed deposit in his name, and hence, he can of course look to break that fixed deposit and reduce the loan quantity by paying off more as down payment than the minimum that's required. So he can use a couple of measures like that. If he has any other liquid investments, he can try and pay that off and reduce the loan quantity. In any case, the finance minister has made interest beyond 2 lakhs that cannot be set off, and hence, he can back calculate to see, how much loan he can take, and the rest he can try to pay through down payment.
Okay, and one final question that Gyanesh sent: will an HUF account be beneficial in this case? Should the family go and make an HUF account?
I would suggest not. The point simply being that while it does look more attractive from a tax perspective, I think increasingly in the recent years, taxmen have been quite stringent about how you use HUF, how you use gifts, and so on. So, for example, he's also mentioned that his daughter-in-law is in the 10% tax bracket. So he can give a gift. His son can give a gift to his wife, and she can buy the property. But even then, the income from the property, the taxman would be quite valid in saying that he should pay at the 30% tax on the income. And similarly the HUF. So taxmen are quite stringent about how you show an HUF into existence and how you fund the HUF. So I would suggest it's better to keep it simple and take it on you can take it on a joint name if necessary and pay tax as per the slabs.
So so file your returns as an individual and not as an HUF in this particular case at least. Question from Mr. Tiwari next. He says he took a home loan of 43 lakh rupees in February of 2016. Now he pays an EMI of 40,000 rupees and says that his outstanding amount till date is 30 lakh rupees and the loan tenure will end in 2026. He has 4 SIPs of 2,000 rupees each and says that the accumulated fund as of today in the SIP is 6 lakh rupees. Salary is around 3 lakh rupees per month and he only works 7 months in a year. He asks us if he should, one, break his SIPs now and make a part payment of the loan, or should he continue paying the SIPs? Would you actually advise someone who has salary 7 months in a year to break the SIP and pay off the loan?
No, I would not advise it. And I think there are 2 good reasons why not. One is that, I think this gentleman would fall under the highest tax slab of, 30.9% because he's already indicated an income of 21 lakhs in those 7 months. So given that, and given the home loan tax rebate that he would be receiving, his post-tax cost of the loan comes to 7% or slightly less than that. Now he can be fairly confident that a long-term SIP should get him better returns than that. And hence, just economically speaking, it doesn't make sense to break an SIP and try to prepay the loan unnecessarily. The second point is a little more subjective but equally important, which is that the SIP serves as a good contingency fund for you in case you need money in an emergency in the years to come. So if you break the SIP and pay off the loan, it's going to be very difficult for you to raise the money again should you need it at short notice. Whereas if you keep the loan going, keep the SIP going, it's always available to you at a rainy day. So given those two things, I think he would be advised to continue his SIP and continue the loan as well.
And he seems to be comfortably placed. Salary of 3 lakh rupees per month. He has SIPs. He has a monthly investment that he's doing, and at the same time, there's his home loan as well. So he's essentially creating two assets, and it really makes no sense for you to break one asset to create another one, to build another one in that sense. You would rather have both the assets growing at the same time, and that should bring you more benefits, in fact. Question from Gaurav next. Gaurav's father says that he owns a plot of land where he plans to construct a house. Now he's planning to buy the land from him. Can he avail a bank loan for purchase of land?
Right. So this is a related party transaction, and hence a lot of banks are going to be very stringent about how they value this property. In fact, most banks would appoint an independent valuer and try to get a valuation of this property simply to avoid a situation where a person can just inflate the value of the property and get a higher loan than what's expected. A few banks could refuse the loan, but I think what most banks would do is if he applies for a loan, they will independently try and value the property and give a loan for the lower of the two amounts, which is the amount that he actually pays versus what the banks value. They would take a haircut on that and give the lower of the two amounts as the loan.
Okay, so not just if you're actually taking a loan to buy it from your relations, and when you say related party transaction, I want to get this cleared over here. Does it only mean father to son, mother to daughter? What is related party?
So income tax laws, one source we have to look at what is related parties, income tax laws on gift, etc., where they define almost any blood relation or spouse of the blood relations as relatives. So linear ascendants, descendants, brother, sister, spouse of the same, they are all defined as relatives. In this case, I think the bank would look at whether there is reason to believe that the valuation being paid on the house is not the real valuation. If the bank has any reason to suspect that, even if the relation is a little far, they are within their rights to independently try and value this.
Okay. Also, in cases like this, does it make sense for him to go shopping in the sense that actually approach 3 or 4 banks and get quotes from all of them in a way? Because all of them are anyway going to get that asset valued.
Yes, of course. I think in any case, while purchasing a property, even if it's whether it's from a related party or not, I think a little bit of shopping is always a good idea because you get better terms on one or the other in terms of tenure, EMIs, value, etc. So I think he can do that here as well.
Right. So that's what you need to do. Go and approach at least 2 or 3 banks. See who's giving you the better offer and then go ahead and finalize that home loan. Moving on, Syed sends us a question through email. Now he says that he purchased a property worth 32 lakh rupees and has taken a loan of 85% for it. Now his father has a flat worth 1.3 crore rupees and plans to sell it. The money, he says, will be distributed equally in 3 parts. Syed wants to know if he can repay the loan with the amount that he will receive from his father.
Right. So what Syed is essentially saying is that his father is going to sell the property and gift him the proceeds, which is perfectly valid. As we just discussed, a gift from a father to a son is valid and is not taxable in the hands of the son as a gift. And hence, but given that the amount is fairly large, it would be good for Syed to create a gift deed and get it signed by him and his father. So that later, if there's any query on what are the source of funds for this, he can substantiate it with the gift deed, and the father can show the source of funds if asked. But subject to that, he can of course use that gift in any form or way that he likes.
Right, you can use it. It's your money that your father is gifting you. You can do whatever you please with it. But from the personal finance point of view, would you recommend that this is a windfall that he's in a way getting, would you recommend that he use it to pay off a home loan, or would you recommend that he invest it somewhere?
So I think that's a little bit of a question that depends on his other circumstances. We don't know much about.
I'm assuming here that Syed has a decent income and that he's well settled in life. Now this is windfall that he's getting. What do you do with windfall gains like this?
Right. So I think in that case, if all is well and he has the ability to repay, then as we saw in the other case as well, you should continue your SIP or you should make an investment. If you have a windfall gain, it's invariably better to invest it in a good yielding asset because the post-tax cost of a loan that you're repaying always comes out to be lower than what you make in a long-term investment. So economically, it just makes a lot of sense to keep that option value with you, invest it somewhere, and continue to pay the loan, assuming, of course, you are able to do it without any problems.
Right. Assuming all is well, it always makes sense, Syed, to use money that you're getting out of the blue, like in your case, to actually build another asset rather than use it to pay off a loan. And a home loan, in that sense, is one of the cheapest loans in the market, and the tax rebate doesn't hurt either. Moving on, we have Bharti, who says that she and her brother have taken a joint loan for a flat that is registered jointly in their names. Now they plan to transfer the loan to one applicant so that they can purchase another property on either of their names. Now she wants to know the process to remove the name of the co-applicant. What paperwork needs to be done? Before we answer the question, I really want to ask Bharti, and I wish we could have got her on the phone, as to which bank offered her a joint loan with her brother, because banks are very wary of lending to sisters for whatsoever reason. What do you say?
Yeah, so I think I have seen a couple of few banks which have given these kind of loans. So it's probably not very common, but it is possible. In this case, it's simply a question of one of the parties being able to convince the bank that they can pay off the loan on their own. So let's say Bharti is that person. She needs to resubmit her proofs of investment, income, and so on, so that the bank is convinced that she can support the loan on her own. And then if she makes an application to that effect, the bank will take its own time for the due diligence, and probably charge the processing fee once again. But after that, it should grant her the exclusive, title on the loan and the property.
Right. And of course, the other thing, since it is a joint loan, it's a joint property, and say Bharti wants complete ownership of the property, there's a lot to be done as far as transferring the title in her name is also concerned, right? Just changing the loan agreement is not going to help her. It's
not going to help her. She will have to transfer the title. And in this case, there is a much lower level of stamp duty to be paid if the transfer is again between blood relatives. So she can, approach the registrar and make a transfer. There is a minimal stamp duty to be paid, which varies from state to state, for a transfer between blood relatives, and make a deed to that effect.
Right. So there you go, Bharti. If your papers are in order, it shouldn't be too much of a problem. Suhail Sharma sends us a question through email, and he says that he's about to retire and wants to purchase a flat in his name and also include his wife's name. Now he's applying for a home loan and wants his son, who is an NRI, to be a co-applicant. Suhail Sharma wants to know if this is possible.
Well, so one thing which is definitely the bank will insist is that, if you want his son to be a co-borrower, he has to be a co-owner of the property. So it can't be that the parents are the owners and the loan is in the name of the son or also in the name of the son. That cannot happen. Now, having said that, in this case, I think the bank has a few yellow flags, if I may say, that they will watch out for. One is that he is close to retirement and hence, he's eligible only for a very short tenure loan. His son also being an NRI, banks have their own issues with, how to chase such borrowers, and hence they may apply their own due diligence to that. But if they have sufficient income, both the son and the father, to justify this, a bank should offer a low duration or a low tenure loan to them on this, of course, making their son also as a co-owner of the property.
Right. And when you say co-owner of the property, what Ram essentially means over here is that your son's name should be on the property papers. So the agreement that you sign with the developer, if it's a flat that you're buying, then the agreement should be made in the name of yourself and your son, and it should be registered accordingly. Only that will make your son a co-owner, and Basis that, the bank will then give you a loan as co-applicants. We have Ratan who sent in a question through email again, and he says that he pays over 3 lakh rupees as interest on his home loan. Now he wants to know how he can maximize tax benefits on that loan. And we don't know if it's the first or second home, but it really doesn't matter anymore now, right?
Yes, yes. So I think the way it used to work till earlier this month was that you would declare such a property, you would rent out such a property, show a rental income on that property, and set off the interest paid against the rental income. In most cases, it would turn out to be a loss because your interest would be much higher than the rent received, and hence you could set off that loss against your salary and so on. Now,
this is for the second house.
This is for the second house. This is for a house that you have let out and not self-occupied. Now, here, of course, in the recent budget, the finance minister has changed this proposal. So even if you let out the house, you still can claim interest only up to rupees 2 lakhs and set that off against income from house property. So what you would need to do is, assuming if you have another house, you can let this house out, or else you can self-occupy it. In either case, you can claim up to rupees 2 lakhs as a deduction. Beyond that, you can only carry forward the loss for future years. You cannot set that off against income from salary or any other income.
Right. But Ram, tell me this, what was announced in the budget? When does it actually come into force? We are in tax season right now. So this year, that is for this assessment year, can Ratan still claim that exemption that he was getting?
Yes. None of these laws apply retrospectively. So for the year that's going to end 31st March, still the old rules will apply. The finance bill will be passed now, and the rules will kick in from 1st of April.
So for the tax return that you will be filing this year, you can still avail of that limitless deduction that you were getting on interest on the second home loan. However, from next year onwards, that will also be capped at 2 lakh rupees. Jayant sends us a question through email and says that he plans to take a loan for a ready-to-move-in property, but due to cash crunch, he's thinking of registering the property 2 to 3 months after possession. In this case, will the bank disburse 100% of the loan, or will disbursement happen after registration? Ram?
So, I guess he should be knowing the developer reasonably well if he wants to occupy a ready-to-occupy property without, paying it or registering it. But in either case, the bank is going to be very, very conservative about these things. So it's going to insist on a registration and, transfer of that lien to the bank before it's going to disburse a loan. And moreover, it is going to ask for proof of you having paid, 15-20% as down payment to the developer before it can sanction the remaining part as a loan. So unfortunately, even if you have a cash crunch, I think you have no option but to register it on occupation, and you get no special benefit by delaying registration.
Right, and in fact, those are the things that you need to keep in mind when you do plan to buy a house, because it is not just the home loan, and the home loan, remember, covers only 80% of the cost of the house. 20% is what you have to be prepared to fork out from your own savings. Apart from that, of course, you need to be prepared to pay a whole host of taxes, which add up to an easy 10% on the value of your house. Would that be right?
Yeah, it depends on state to state, but 5 to 10% is quite common.
And this is not covered by any home loan. So what you need to be prepared is for 20 plus 10, almost 30% of the cost of the house. That has to come out of your pocket. That has to come from friendly loans, from loans from friends and family. Only then should you actually go out over there and buy a home. In fact, that is a good exercise in figuring out what is your budget for the home, because that is not that of course is dependent on loan eligibility, but it's also dependent on how much money you already have in the bank. With that, of course, we come to the end of this episode of Property Hotline. Ram, thank you very much for coming in and answering all those questions. And of course, any questions related to real estate, you can send them in to us, call, write, or personally tweet to me. We'll make sure that each and every question is answered. Thank you for watching.
You can watch live TV on our website mbnow.in. Find us on Facebook at facebook.com/Magicbricks Now. And don't forget to click the like button. You can also follow us on Twitter at Magicbricks Now. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/Magicbricks Now.